For years, I've sat across the table from high net worth individuals who did everything right, business owners who maxed out their 401ks every year, and engineers who lived well below their means. And yet I've watched them walk into retirement with a complete false sense of security, completely unaware of the potential storms waiting just past the finish line. They thought they were safe because they weren't reckless, but the danger wasn't recklessness. The danger was a system that punishes good decisions made in the wrong order. And the part that keeps me up at night is that these people didn't lose money because of a bad investment. They lost it because of the tax structure that they didn't see coming and that no one unfortunately told them about. If you've been saving for decades responsibly, then this might actually be one of the most important videos you've ever watched. Because there's a point in every retirement plan where the game flips. If you don't know the playbook by then you might lose. By the end of this video, you will learn the steps to help you avoid this fate and how to turn the system in your favor before it's too late. Let's start where many people go wrong. They believe that retirement is all about how much you save, but retirement is also about how much you're keeping after taxes. The silent threat that many people don't talk about is that retirement income can be fully taxable, that money from your 401k, your traditional IRA, and even Social Security can be taxable. The money you saved and invested during your working years can still be taxed when you're in retirement, depending on how much income you have coming in. Suppose that you retire with $1.5 million in your 401k. You feel great about this number and all the hard work that you've done to reach this goal. But the IRS doesn't care about that number. They just care that you pay taxes on your taxable income. When required minimum distributions, or RMDs for short, kick in around age 73, they don't care, the IRS, about whether or not you need that money. They just care that you're taking out what you're supposed to take out and pay taxes on that dollar amount every year. Even worse, those withdrawals can actually push you into a higher tax bracket. This in turn can trigger your Social Security payments to become taxable, and it can put you into a higher tax bracket, which then impacts your Medicare premiums potentially. It is a domino effect. Here's what it looks like in real numbers. If your total income exceeds $34,000, then up to 85% of your Social Security is subject to taxation. According to the Tax Foundation, someone with $1 million in their regular traditional 401k account could potentially lose somewhere between $250,000 to $300,000 to federal and state taxes over the span of their retirement. It's not a small leak, but a silent wealth drain happening to people who thought that they had planned well. But this isn't just about tax brackets or government rules, it's about control. When your retirement income is all taxable, you have no control over what you keep. The IRS does. Before we get into tactics, let's get one thing straight. Tax-free retirement income is achieved when you set up the right tools early and intentionally. There are only 3 tools that matter here. These are the building blocks that you need to understand if you'd like to create a tax-free retirement stream of income. The first is the Roth IRA. So this account allows you to put in after-tax dollars. Once the money is in the account, it grows and it compounds tax-free. Then once you're 59 and a half and you've had the account for 5 years, you're able to tap into that growth without any kind of tax or penalty. Sounds simple, but the key is starting early and funding this account consistently. Secondly, it's the Health Savings Account, or HSA for short. Few people realize that this triple tax advantaged account is arguably one of the most powerful tools if used correctly. And third is the concept of strategic Roth conversions. By converting traditional pre-tax funds into your Roth account, you are able to manage your tax brackets and set yourself up for tax-free income and retirement later. Now, as always, you should consult a tax advisor to make sure that the Roth conversion makes sense for your personal situation, and of course, a certified financial planner. We're able to model to see if the conversion would make sense for your plan. Understanding these 3 tools and when to use them can change everything. And that brings us to strategy, the step-by-step plan that can help shift you from tax burdened to tax-free. Now I'll walk you through the steps of how to build a tax-free income in retirement, which starts with understanding how different types of income are taxed, and then positioning your money in the appropriate accounts before retirement hits. The first step is putting your money into what is called a Roth bucket. This means putting your money into a Roth IRA or Roth 401k where you pay your taxes up front, but then in retirement you enjoy tax-free withdrawals. To qualify, you must have had this account for at least 5 years and be 59 and a half or older. If you're already that age or older, then you're in an excellent position to start accessing this bucket. If you don't already have a Roth IRA, then there are 2 main ways to build one. One, you can contribute directly to a Roth IRA. As long as if you're single, you make under $161,000 per year, or if you're married and filing jointly, you need to make $240,000 or less a year for married couples filing jointly in 2025. Your second option is to do what is called a Roth conversion. A Roth conversion is when you move pre-tax dollars from your 401k or traditional IRA into the Roth IRA. Now, when you do this, the money is added to your taxable income for the year, but moving forward, it grows tax deferred, and then the money is accessible to be withdrawn tax-free once you've had the account for 5 years and you're over 59 and a half. The second step is to use your Roth conversions wisely. It is one of the most powerful strategies when used correctly, especially in your early retirement years when your income might be lower before you've started to collect Social Security or before you start receiving your minimum required distributions. Suppose you retire at 62 and delay Social Security until 67. This 5-year window is ideal for Roth conversions. You can gradually shift money into your Roth IRA without pushing yourself into a higher tax bracket. Done correctly, this not only reduces your future tax bill, but also potentially lowers the amount of your RMDs down the line. And that can even help to lower your Medicare premiums. The next step is to consider a tax-free life insurance strategy. Specifically, if you're under 60 and still saving aggressively for retirement, permanent life insurance like an indexed universal life can provide tax-free income in retirement. Now, this only works if the policy is designed in the right way. That means lower fees, max funded for cash value, and backed by a reputable insurer. Now, this option isn't for everyone. It's really something that could be useful for high income earners who've already maxed out their 401k, their Roth options, and they're putting money towards potentially a brokerage account already. Then there is step 4. And step 4 is shifting to municipal bonds for tax-free interest. These bonds are issued by state and local governments, and their interest is typically exempt from federal taxes. In some cases, the interest is also exempt from state taxes, of course, depending on where you live. This makes them a perfect option for people who want low-risk, income-producing assets in retirement that won't increase their taxable income. Municipal bonds won't work for everyone, especially for those in lower tax brackets. These are really good for higher income earners. They offer a clean way to generate income without adding to your tax burden. Finally, once you retire, how you withdraw your money matters just as much as where your money is coming from. So we're now going to discuss a smart withdrawal option that could potentially save you thousands in taxes over your retirement. A common approach is to start with your taxable accounts first. Draw down off of those accounts while your Roth IRAs and your 401ks are growing and compounding in the background. This allows your tax-deferred money to keep keep growing while minimizing the amount of taxable income that you report each year. During this time, you can also take a look at if Roth conversions would make sense. If you do start to pull your money out and do Roth conversions in this time frame, then you could potentially make the size of your RMDs smaller when it's time to take those. All of this works best when monitored year to year. Your income, the market, and tax code can change quite often. So reviewing your plan annually is important to stay ahead. Even with all of this information, most people still fall into these traps, mostly because they're working off of outdated assumptions or trying to copy strategies that don't fit their particular situation. One of the biggest misconceptions is that you're going to be in a lower tax bracket when you retire. In fact, a 2023 study by the Tax Policy Center showed that over 40% of middle to upper middle income Americans were actually in a higher effective income tax bracket in retirement than they were in their working years. Because Social Security can become taxable, you have your required minimum distributions or RMDs that can push you into a higher tax bracket, or maybe you have rental property or a pension or an annuity. All of this can stack on top of each other. And if you don't plan for this in advance, then you can get an unhappy surprise tax bill in retirement. Another common mistake I see is waiting to do Roth conversions too long. Many people don't feel comfortable paying the tax now, and the longer you keep the money in that bucket of pre-tax, it will grow and compound. And then by the time that you're 73 and RMD age, you've got a large bucket of money that you have to pull from that is fully taxable. At this point, it is too late to reposition. In my opinion, the best time to do Roth conversions when considering everything is going to be early retirement, specifically before you start having to take RMDs or Social Security. Life insurance is another area where people can get tripped up. There's a big difference in between using life insurance for a death benefit or using life insurance as a tax-free income tool. The latter requires careful structuring. If you're going to use life insurance as income, it has to be done with precision and the help of someone who can help you design and structure it properly. Then there is the issue of Social Security. Many of you don't realize that up to 85% of your Social Security can become taxable if your combined income exceeds the income limits. For single filers, that limit is only $34,000, and for married filing jointly, the limit is $44,000. Your combined income includes your adjustable gross income, your non-taxable interest, and half of your Social Security benefit. Even municipal bond interest can push you over the line. If you're not managing your income sources carefully, you could end up losing a big chunk of your Social Security check to taxes each year. Moreover, people also underestimate how fast tax laws can change. The current tax brackets from the 2017 Tax Cuts and Jobs Act is actually set to expire at the end of 2025. If Congress doesn't act, we will go back to higher tax rates in 2026. That means the window to take advantage of low rates, especially for things like Roth conversions, could be closing fast. If you wait for certainty, you may miss out on opportunity. Finally, the biggest mistake is treating tax planning as optional. People assume it's something extra that they will take advantage of and plan for later, but the truth is, if you ignore it, you will pay for it later. Even a 1% higher effective tax rate stretched out over 25 to 30 years could mean that you lose hundreds of thousands of dollars to taxes. That money could have stayed in your pocket. The good news is once you understand how it works, you can take control and you do not have to be a tax expert. There was a couple in their 60s, they were recently retired, who had about 1.2 million saved. Now this money was saved in a mix of traditional IRA and 401k accounts. All of it was tax deferred. They assumed that since they were retired, their tax rate would drop. But when we ran the numbers, we found that that was not the case at all. Their income from Social Security, RMDs, and a small pension was going to push them into a higher tax bracket than expected. Worse, it triggered Medicare surcharges and taxed their Social Security benefits. So we put a plan in place that included small Roth conversions each year to reduce their future RMDs, and a tax-free income stream through a cash value life insurance policy. Now nearly 40% of their retirement income is tax-free, and they have more flexibility with their money in retirement. retirement. Most people think that taxes are something that they'll worry about later, but by then the damage is already done. Once those RMDs kick in, you lose control. Your money is on the IRS's schedule, not yours. But it doesn't have to be that way. With the right plan, you can turn the years before retirement into your most powerful tax saving window. If you want to see exactly how this could work for your particular situation, then I'm offering a no cost, no obligation retirement tax review. Together, we'll map out a path to building tax-free retirement income. Click the link in the description to book your session. It's your move now, so don't let taxes write the next chapter of your retirement story. As always, thank you so much for watching today. And if you like this video, please click here to watch this video on my 3-bucket strategy and retirement. Thank you, and as always, have a lovely day.